1. Intercorporate acquisitions and investments in other entities. Based on the book Intercorporate, Acquisitions and Investments in Other Entities, the statement the development of complex business structures, enterprise expansion as a means of survival and profitability means that companies often seek to grow and expand their operations as a way to remain competitive and profitable in the marketplace. Expanding a company's size can lead to economies of scale, which means that the cost per unit of production decreases as the size of the company increases. This can result in cost savings, increased efficiency, and greater profitability. Moreover, expanding a company's size can also create new earning potential through access to new markets, customers, and products. By diversifying its operations, a company can achieve earning stability by reducing its reliance on any one product or market. In addition, larger company size can lead to management rewards, such as higher salaries, bonuses, and stock options, and also can be associated with greater prestige in the business world. Therefore, the development of complex business structures and enterprise expansion can be a means for companies to achieve survival, profitability, and success in the long run.
Is a company that is controlled by another company, known as the parent company. The parent company owns more than 50% of the subsidiary's voting stock, giving it the power to make important business decisions for the subsidiary. The subsidiary operates as a separate legal entity and maintains its own financial records, but it is subject to the control and influence of the parent company. Manipulation of financial reporting. This refers to the intentional misrepresentation of financial information by a company to make it seem more or less profitable or financially stable than it really is. Usage of subsidiaries or other entities to borrow money without reporting the debt on their balance sheets. This is a method used by companies to hide the debt and make their financial statements appear stronger. They create a subsidiary or other entity to borrow money, and the debt is not reported on the balance sheet of the parent company. Using special entities to manipulate profits. Companies may use special entities or off-balance sheet transactions to manipulate their reported profits. For example, they may create a special entity to sell assets to, so that the profits from the sale do not have to be reported on their financial statements. Manipulation of accounting for mergers and acquisitions. This refers to the improper accounting practices used during mergers and acquisitions to make the financial position of the combined company appear more advantageous than it really is. Pooling of interests. This refers to an accounting method used in mergers or acquisitions, where the assets and liabilities of the acquiring and target companies are combined at book value. This method has been largely replaced by the purchase accounting method. Expansion from within. This refers to a company's strategy of creating new subsidiaries or entities, such as partnerships, joint ventures, or special entities, to expand its operations. Motivating factors. There are several reasons why a company may choose to expand from within. Helps establish clear lines of control and facilitate the evaluation of operating results. By creating subsidiaries or entities, a company can better monitor the performance of its various operations. Special tax incentives. Some jurisdictions offer tax incentives for companies that create new subsidiaries or entities. Regulatory reasons. In some cases, a company may need to create a subsidiary or entity to comply with regulatory requirements. Protection from legal liability. Creating a subsidiary or entity can help protect the parent company from legal liability that may arise from the operations of the subsidiary or entity. Disposing of a portion of existing operations. A company may create a subsidiary or entity for the purpose of disposing of a portion of its existing operations. This can help the company focus on its core business, while still maintaining some presence in the disposed operations. A spin-off. This is a type of corporate restructuring where a parent company creates a new subsidiary or chooses an existing subsidiary, and distributes ownership of the subsidiary to its existing shareholders in the form of a dividend. Unlike a traditional dividend, however, the shareholders do not surrender any of their stock in the parent company. The new subsidiary becomes a separate publicly traded company with its own management and financial statements. A split-off. This is another type of corporate restructuring where a parent company exchanges the shares of its subsidiary for the shares of the parent company. The subsidiary then becomes a separate publicly traded company, and the outstanding shares of the parent company are reduced. Shareholders of the parent company are given the option to exchange their shares for shares in the subsidiary at a predetermined exchange ratio. Expansion through business combinations. This refers to a company's strategy of expanding its operations by acquiring or combining with other companies. This can be done to enter new product areas or geographic regions. A business combination. This occurs when one company, known as the acquirer, obtains control of one or more businesses. Control is defined as the ability to direct policies and management of the acquired business. Business combinations can take many forms, including mergers, acquisitions, and consolidations. The concept of control is a key concept in business combinations. When a company acquires control of another business, it gains the ability to make important decisions about the operations and direction of the acquired business. Control can be acquired through various means, such as owning a majority of the voting stock in the acquired business or having the power to appoint the majority of the board of directors. Traditional view. The traditional view is that control is gained by acquiring a majority of a company's common stock. This means that the acquirer owns more than 50% of the voting shares of the target company, giving it the power to make important decisions and direct the operations of the company. However, it is possible to gain control with less than majority ownership or with no ownership at all. This can occur through informal arrangements, such as a company having significant influence over the management or operations of another company. It could also result from formal agreements, such as a voting agreement or proxy agreement, between two or more parties. Consummation of a written agreement. When a combination occurs through a written agreement, such as a merger or acquisition agreement, it is important for the transaction to be recognized on the books of one or more of the companies that are parties to the combination. This includes accounting for any assets or liabilities acquired as a result of the transaction, as well as any changes in ownership structure. The agreement must comply with relevant regulations and accounting standards. Frequency of business combinations. The frequency of business combinations has varied over time. 1960s merger boom. In the 1960s, there was a boom in the number of mergers and acquisitions. This was driven in part by the rise of conglomerates, which were large corporations that owned diverse businesses unrelated to their primary operations. 1980s, increase in the number of business combinations. In the 1980s, there was another increase in the number of business combinations. This was due in part to the rise of leveraged buyouts, which were acquisitions that were heavily financed with debt. 1990s, all previous records for merger activity shattered. In the 1990s, the previous records for merger and acquisition activity were shattered, as companies sought to expand and consolidate in response to globalization and other factors. Downturn of the early 2000s, and decline in mergers. The early 2000s saw a downturn in the economy, which led to a decline in the number of mergers and acquisitions. The financial statements of the subsidiary will also be prepared, but will reflect only the financial information of the subsidiary itself.
Downturn of the early 2000s and decline in mergers. The early 2000s saw a downturn in the economy, which led to a decline in the number of mergers and acquisitions. Increased activity toward the middle of 2003 that accelerated through the middle of the decade. However, merger activity picked up again in the mid-2000s, with increased activity from private equity firms and other investors. Role of private equity. Private equity firms, which are investment firms that focus on acquiring and restructuring companies, have played a significant role in many recent mergers and acquisitions. Effect of the credit crunch of 2007-2008. The credit crunch of 2007-2008, which was a global financial crisis that led to a tightening of credit markets, had a significant impact on mergers and acquisitions. Many planned transactions were put on hold, and the overall volume of deals declined significantly. Organizational structure and financial reporting. Merger. A merger is a type of business combination where the assets and liabilities of the acquired company are combined with those of the acquiring company. This typically results in no additional organizational components being added to the acquiring company. Financial reporting. After a merger, financial reporting is typically based on the original organizational structure of the companies involved. This means that the financial statements of the combined company will reflect the financial position, cash flows, and results of operations of the two companies as though they had always been one company. This is known as the pooling of interests method of accounting, which is no longer allowed under current accounting standards. Under the current accounting standards, the acquiring company will record the assets and liabilities at their fair values, while any excess payment over the fair value will be recorded as goodwill. The financial statements of the combined company will reflect the financial position, cash flows, and results of operations of the two companies as of the acquisition date. Controlling ownership. A business combination can take the form of a controlling ownership, where the acquiring company retains the acquired company as a separate legal entity, and owns a majority of its common stock. This forms a parent-subsidiary relationship, where the acquiring company has control over the operations and direction of the acquired company. Accounting standards. Accounting standards require that the parent company prepare consolidated financial statements, which include the financial information of both the parent company and its subsidiaries. This means that the financial statements of the parent company will reflect the financial position, cash flows, and results of operations of both the parent company and its subsidiaries as though they were one company. The financial statements of the subsidiary will also be prepared, but will reflect only the financial information of the subsidiary itself. Non-controlling ownership. The purchase of a less than majority interest in another corporation does not usually result in a business combination or controlling situation. This means that the acquiring company does not have the power to direct the operations or management of the target company. Other beneficial interest. It is possible for one company to have a beneficial interest in another entity even without a direct ownership interest. This may result from agreements or arrangements between the two entities, such as operating agreements or financing agreements. The beneficial interest. A beneficial interest may be defined by the agreement establishing the entity or by an operating or financing agreement. This means that a company may have a right to receive certain benefits or have obligations related to the performance of the other entity, even if it does not have direct control over the entity or a direct ownership interest in it. The nature and extent of the beneficial interest will depend on the terms of the agreement or arrangement between the two entities. Creating business entities. Transfer of assets through a newly created and controlled entity. A company may transfer assets, and perhaps liabilities, to an entity that it has created and controls, and in which it holds majority ownership. This newly created entity is known as a special purpose entity, SPE. Transfer at book value. The transferring company will transfer assets and liabilities to the newly created entity at book value, which is the value of the assets and liabilities as they appear on the company's books. The transferring company recognizes an ownership interest in the newly created entity equal to the book value of the net assets transferred. Role of the special purpose entity. The special purpose entity is typically used to isolate and protect certain assets and liabilities, or to facilitate financing transactions. The assets and liabilities transferred to the SPE are recorded on its books, rather than those of the transferring company. This allows the transferring company to manage its operations more efficiently, as it can focus on its core business without having to worry about the transferred assets and liabilities. Recognition of fair values. In the absence of an arm's length transaction, recognition of fair values of the assets transferred in excess of their carrying values on the books of the transferring company is not appropriate. This means that if the transferred assets have a higher fair value than their carrying value on the books of the transferring company, the difference is not recognized as a gain. No gains or losses. No gains or losses are recognized on the transfer by the transferring company when the transfer is to a special purpose entity that it controls. This is because the transfer of assets is considered to be within the same economic entity, and therefore the economic substance of the transaction does not change. As such, the transfer does not result in any gains or losses for the transferring company. Arm's length transaction. An arm's length transaction refers to a transaction between two parties that are independent of each other and have no special relationship. In this context, it means that the fair value of the assets transferred should only be recognized if the transfer is made at an arm's length price, where the transaction is fair and impartial to both parties. If such a transaction does occur, any difference between the fair value and the carrying value of the assets is recognized as a gain or loss by the transferring company. Creating business entities. If the value of an asset that is being transferred has been impaired prior to the transfer, and its fair value is less than the carrying value on the books of the transferring company, the transferring company should recognize an impairment loss and transfer the asset to the new entity at the lower fair value. Impaired assets. An asset is considered to be impaired if its carrying value on the books of the company is greater than its fair value or if it is no longer expected to provide future economic benefits to the company. When determining the fair value of the asset, the company must use reasonable and supportable assumptions, which may include input from independent valuation experts. Recognition of impairment loss. If an asset has been impaired prior to the transfer, the transferring company must recognize an impairment loss in its financial statements. The impairment loss is the difference between the carrying value and the lower fair value. Transfer at lower fair value. The transfer of the asset to the newly created entity should be made at the lower fair value rather than the carrying value on the books of the transferring company. This ensures that the financial statements of both the transferring company and the newly created entity reflect the statement, forms of business combinations. A statutory merger and a statutory consolidation refers to two types of legal structures that can be used for combining two or more companies into a single entity, as described in the book, Intercorporate Acquisitions and Investments in Other Entities. A statutory merger is a business combination in which one company, the acquiring company, acquires another company, the acquired company, by transferring the acquired company's assets and liabilities to the acquiring company. The acquired company is then dissolved or liquidated, and its operations are carried on within the acquiring company as a single legal entity. In other words, the acquiring company absorbs the acquired company's operations and becomes the sole owner of its assets and liabilities. On the other hand, a statutory consolidation is a business combination in which two or more companies combine to create a new, single legal entity. In this type of combination, both companies are dissolved and their assets and liabilities are transferred to a newly created corporation. The operations of the previously separate companies are then carried on within the new corporation. Overall, both statutory merger and statutory consolidation are legal structures that enable companies to combine their operations and resources in a way that can result in increased efficiency, profitability, and competitiveness in the marketplace. The statement, a stock acquisition. One company acquires the voting shares of another company, and the two companies continue to operate as separate, but related legal entities, refers to a type of business combination in which one company acquires a controlling interest in another company by purchasing the target company's voting shares. The target company then becomes a subsidiary of the acquiring company, and the two companies continue to operate as separate legal entities. In this type of combination, the acquiring company accounts for its ownership interest in the target company as an investment, and the two companies are generally subject to separate legal and regulatory requirements. The acquiring company can exercise control over the subsidiary through its ownership of voting shares, but it does not necessarily have operational control over the subsidiary's day-to-day operations. This type of relationship is known as a parent-subsidiary relationship, in which the acquiring company is the parent and the target company is the subsidiary. For financial reporting purposes, the parent company and its subsidiaries typically present consolidated financial statements that reflect the combined financial results of the parent and its subsidiaries as if they were a single entity. This allows for a more accurate and comprehensive view of the overall financial performance of the group, rather than just the individual financial results of each company. Methods of affecting business combinations. Acquisition of assets, statutory merger, statutory consolidation. Acquisition of stock, non-controlling interest. Acquisition by other refers to different ways in which companies can combine their operations and resources into a single entity. Acquisition of assets is a method in which one company acquires some or all of the assets and liabilities of another company. The acquired assets and liabilities become part of the acquiring company's balance sheet, while the acquired company is dissolved or liquidated. Statutory merger and statutory consolidation are the legal structures described in the previous answer, where companies can combine their operations and resources. A statutory merger involves one company acquiring another company and dissolving it, while a statutory consolidation involves two or more companies combining to create a new legal entity. Acquisition of stock involves one company acquiring a controlling interest in another company by purchasing a majority of the outstanding voting shares. The acquiring company gains control over the target company by owning a controlling interest in it. Non-controlling interest refers to the total shares of an acquired company not held by the controlling shareholder. In a stock acquisition, the acquiring company may own a controlling interest in the target company, but there may be other shareholders who own a non-controlling interest. Finally, acquisition by other means refers to other methods that companies may use to combine their operations and resources, such as joint ventures, partnerships, and other contractual arrangements. Valuation of business entities. Value of individual assets and liabilities. Value determined by appraisal. Value of potential earnings. Going concern value, based on a multiple of current earnings. Present value of anticipated future net cash flows generated by the company. Valuation of consideration exchange. Refers to various methods used to determine the value of a business entity for the purpose of an acquisition or investment. One method of valuation is to determine the value of individual assets and liabilities, which involves assessing the fair market value of the individual assets and liabilities on the company's balance sheet. Another method is to determine the value of potential earnings, which involves projecting future earnings potential based on historical financial data, industry trends, and other relevant factors. The going concern value refers to the value of a business as a whole, rather than the sum of its individual assets and liabilities. This can be determined using different approaches, such as a multiple of current earnings or the present value of anticipated future net cash flows generated by the company. Finally, the valuation of consideration exchanged refers to the process of determining the value of the consideration, such as cash, stock, or other assets, that will be exchanged between the acquiring company and the target company in a business combination. This valuation is typically based on the fair market value of the consideration being exchanged at the time of the transaction. Accounting for business combinations. Two methods acceptable earlier: purchase and pooling of interests. FASB eliminated pooling of interests in 2001. FASB 141R replaced the purchase method with the acquisition method in 2007, must be used for all business combinations for which the acquisition date is in fiscal years beginning on or after December 15, 2008. FASB 141R may not be applied retroactively, refers to the different accounting methods used to record business combinations. Previously, two accounting methods were acceptable for business combinations: the purchase method and the pooling of interests method. The purchase method records the acquired company's assets and liabilities at fair value and records goodwill as the excess of the purchase price over the fair value of the net assets acquired. The pooling of interests method records the combination as if the two companies had always been one, with no goodwill or other assets and liabilities recorded. In 2001, the Financial Accounting Standards Board, FASB, eliminated the pooling of interests method due to concerns about its potential for abuse and replaced it with the purchase method. In 2007, FASB 141R replaced the purchase method with the acquisition method, which is similar to the purchase method but requires the acquirer to measure and recognize all identifiable assets acquired, liabilities assumed, and any non-controlling interest in the acquired entity at their fair values at the acquisition date. Goodwill is recognized as the excess of the acquisition price over the fair value of the net assets acquired. The FASB requires the acquisition method to be used for all business combinations for which the acquisition date is in fiscal years beginning on or after December 15, 2008. However, FASB 141R may not be applied retroactively, and the prior accounting methods should continue to be used for business combinations that occurred before the effective date. The statement, acquisition accounting: the acquirer recognizes all assets acquired and liabilities assumed in a business combination and measures them at their acquisition date fair values. If less than 100% of the acquiree is acquired, the non-controlling interest also is measured at its acquisition date fair value. Fair value measurement. The FASB decided in FASB 141R to focus directly on the value of the consideration given, refers to the accounting treatment of a business combination using the acquisition method. Under the acquisition method, the acquiring company recognizes all assets acquired and liabilities assumed in a business combination and measures them at their fair values as of the acquisition date. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. If the acquiring company does not purchase 100% of the acquired company, it recognizes the non-controlling interest in the acquired company at its fair value. Non-controlling interest is the portion of equity in a subsidiary not attributable to the parent company. The FASB has decided to focus directly on the value of the consideration given, meaning that the acquiring company should measure the assets and liabilities at their fair value on the date of the acquisition, rather than using other valuation methods, such as the cost or historical value of the assets and liabilities. Overall, acquisition accounting aims to provide users of financial statements with more relevant and reliable information about the acquired company's assets, liabilities, and earnings potential.
Acquisition accounting. Points to consider: Number 1. No separate asset valuation accounts related to assets acquired are recognized. Instead, the acquiring company recognizes the assets and liabilities of the acquired company at their acquisition date fair values. This means that the acquiring company does not recognize any separate valuation accounts related to the assets acquired. Point number 2. Long-lived assets classified at the acquisition date as held for sale are valued at fair value less cost to sell. If any long-lived assets acquired as part of the business combination are classified as held for sale, then they are valued at fair value less any expected costs to sell the assets. This is in accordance with relevant accounting standards. Point number 3. Deferred income taxes related to the business combination and assets and liabilities related to an acquiree's employee benefit plans are valued in accordance with the relevant FASB standards. This means that any deferred income taxes related to the business combination and any assets and liabilities related to the acquired company's employee benefit plans are valued based on the relevant accounting standards issued by the FASB. Acquisition accounting. Points to consider: 4. Costs of bringing about and consummating a combination are charged to expense as incurred. This includes any costs incurred by the acquiring company during the process of negotiating and executing the business combination, such as legal fees, accounting fees, and investment banking fees. These costs are recognized as expenses in the period in which they are incurred. Points to consider: 5. Costs of issuing equity securities used to acquire the acquiree are treated as a reduction in the paid-in capital associated with the securities. This means that if the acquiring company issues equity securities, such as common stock or preferred stock, to acquire the acquiree, the costs associated with issuing these securities are deducted from the paid-in capital associated with the securities. The paid-in capital represents the amount of capital contributed by investors in exchange for the equity securities. By treating the costs of issuing equity securities as a reduction in paid-in capital, the total amount of paid-in capital is reduced by the costs associated with issuing the securities. Goodwill is the amount of money a company will pay for the purchase of another company that is in excess of the fair value of the net identifiable assets of the company being purchased. Components used in determining the goodwill include the fair value of the consideration paid by the acquiring company, the fair value of any interest in the company being acquired already owned by the acquiring company, and the fair value of the non-controlling interest in the company being acquired, if any. When these three items are added together and compared to the fair value of the net identifiable assets of the company being acquired, the difference is goodwill.
Acquisition accounting refers to the method of accounting used when one company acquires another company. When one company acquires another, the acquiring company must allocate the purchase price paid to the assets and liabilities of the acquired company. Goodwill arises when the purchase price exceeds the fair value of the net assets acquired. Goodwill represents the excess of the purchase price over the fair value of the identifiable net assets acquired. Under accounting standards, goodwill is tested for impairment annually, or more frequently if there is an indication of impairment. To test for impairment, the goodwill is assigned to individual reporting units. A reporting unit is the smallest identifiable group of assets that generates cash flows. The fair value of the reporting unit is then compared to its carrying amount. If the fair value of the reporting unit exceeds its carrying amount, the goodwill of that reporting unit is considered unimpaired. However, if the carrying amount of the reporting unit exceeds its fair value, an impairment of the reporting unit's goodwill is implied. In this case, the amount of the impairment loss is equal to the excess of the carrying amount over the implied fair value of the reporting unit's goodwill. This impairment loss is recorded in the income statement and reduces the carrying amount of the goodwill. This passage is describing the accounting treatment for impairment of goodwill under the acquisition accounting method. When goodwill impairment is detected in a reporting unit, the amount of the impairment loss is measured as the excess of the carrying amount of the unit's goodwill over the implied value of its goodwill. The implied value of the goodwill is the amount that the goodwill would be worth if it were being purchased separately in a hypothetical transaction, and it is determined by subtracting the fair value of the reporting unit's net assets, excluding goodwill, from the fair value of the reporting unit as a whole. In other words, the implied value of goodwill represents the portion of the fair value of the reporting unit that cannot be attributed to its net assets. If the carrying amount of the goodwill exceeds this implied value, it suggests that the goodwill is impaired and a loss must be recognized. The amount of the goodwill impairment loss is recorded in the income statement as an expense, either in income from continuing operations or income before extraordinary gains and losses. This treatment reflects the ongoing operating performance of the business and helps to ensure that investors and analysts have a clear understanding of the company's financial position. In the context of acquisition accounting, a bargain purchase occurs when the total fair value of the consideration given, including any equity interests in the acquiree held by the acquirer, plus any non-controlling interest in the acquiree, is less than the fair value of the acquiree's net identifiable assets. In other words, the acquirer is able to purchase the target company for less than the fair value of its identifiable net assets. If the acquirer is able to accurately value the assets and liabilities of the acquiree and the bargain purchase is confirmed, the acquirer should recognize a gain at the date of acquisition. This gain represents the difference between the fair value of the net identifiable assets acquired and the total fair value of the consideration paid. The gain should be disclosed in the financial statements, along with where the gain is reported and the factors that led to it. It is important to note that under FASB 141R, there is no specific treatment prescribed for the opposite situation, where the total fair value of the consideration given is greater than the fair value of the acquiree's net identifiable assets. In this situation, the acquirer would typically allocate the excess consideration to goodwill, which would then be subject to regular impairment testing as discussed earlier. In the context of acquisition accounting, a combination effected through the acquisition of stock occurs when the acquiring company purchases a controlling interest in the common stock of the acquiree. Under this method, the acquired company continues to exist as a separate legal entity, and the acquirer records an investment in the common stock of the acquiree instead of recording the individual assets and liabilities of the acquiree. The investment is recorded at the total fair value of the consideration given in exchange for the stock. This method is often used when the acquirer wants to maintain the existing brand or operations of the acquiree as a separate entity. In such cases, the acquiree may continue to operate independently, or it may be merged with the acquiring company, depending on the acquirer's objectives. It is worth noting that in this method, the acquirer assumes control over the acquired company through its controlling interest in the common stock of the acquiree. As such, the acquirer consolidates the financial statements of the acquired company with its own financial statements, and any gains or losses resulting from the combination are recognized in the acquirer's financial statements. In the context of acquisition accounting, financial reporting subsequent to a business combination refers to the preparation of financial statements after the acquisition has been completed. Under this method, the financial statements reflect the combined entity only from the date of combination, which is also known as the acquisition date. Any income earned by the acquiree prior to the combination is not reported in the income of the combined entity. This means that if a business combination occurs during a fiscal period, the financial statements for that period will only include the financial results of the acquired company from the date of acquisition onwards. Any financial results earned by the acquired company prior to the acquisition date will be reported separately and are not included in the financial statements of the combined entity. It is important to note that the financial statements subsequent to a business combination will also reflect any changes in the fair value of the acquired company's assets and liabilities. These changes will be recognized in the financial statements of the combined entity, either as a gain or loss in the income statement, or as an adjustment to the carrying value of assets and liabilities in the balance sheet. FASB 141R Disclosure Requirements. 1. Identification and description of the acquired company, the acquisition date, and the percentage ownership acquired. 2. The main reasons for the acquisition and the description of the factors that led to the recognition of goodwill. 3. The acquisition date, fair value of the consideration transferred, the fair value of each component of the consideration, and a description of any contingent consideration. 4. The acquisition date amounts recognized for each major class of assets acquired and liabilities assumed. 5. the business combination-related costs incurred, the amount expensed, and where they were reported, along with any issue costs not expensed and how they were recognized. 6. The acquiree's revenue and net income included in the consolidated income statement for the period since acquisition, and the results of operations for the combined company as if the business combination had occurred at the beginning of the reporting period. 7. The total amount of goodwill, the amount expected to be deductible for tax purposes, changes in goodwill during each subsequent period, and, if the company is required to report segment information, the amount of goodwill assigned to each segment. 8. For less than 100% acquisitions, the acquisition date fair value of the non-controlling interest and the valuation method used. In the context of accounting for business combinations, contingent consideration refers to consideration that is not fixed in amount, but rather is dependent on future events. For example, a contingent share agreement may stipulate that the acquirer will pay additional consideration to the acquiree if certain performance targets are met in the future. Under FASB 141R, contingent consideration must be valued at fair value as of the acquisition date and classified as either a liability or equity in the acquirer's financial statements. The fair value of the contingent consideration is estimated using the most likely outcome or expected value, depending on the circumstances. In addition to contingent consideration, the acquirer must also recognize any contingencies that arise from contractual rights or obligations or other contingencies that meet the definition of an asset or liability at the acquisition date. These contingencies are recorded by the acquirer at the fair value as of the acquisition date. It is worth noting that the recognition and measurement of contingent consideration and contingencies can be complex, and may require the use of professional judgment and estimation techniques. In process research and development, refers to ongoing research and development projects that have not yet reached completion or been approved for commercial use. In the context of accounting for business combinations, if an acquiree has valuable in-process research and development (IPR&D) projects, these projects should be recorded as assets at their acquisition date fair values, even if they have no alternative use. According to FASB 141R, these IPR&D assets should be classified as indefinite-lived, which means that they should not be amortized until completed or abandoned. Instead, they should be tested for impairment regularly, typically on an annual basis or when there is an indication that their fair value may have been impaired. It is important to note that the valuation of IPR&D assets can be complex and may require the use of professional judgment and estimation techniques, such as discounted cash flow analysis or comparable transactions analysis. Additionally, any subsequent development or abandonment of IPR&D projects may impact their fair value, and therefore, the valuation of these assets may need to be reassessed periodically. The passage you provided discusses two additional considerations in accounting for business combinations. The first consideration relates to the treatment of non-controlling equity held by the acquirer prior to the combination. The acquirer must revalue this equity position to its fair value at the acquisition date and recognize a gain or loss on the revaluation. The second consideration relates to acquisitions by contract alone. In such cases, the amount of the acquiree's net assets at the date of acquisition is attributed to the non-controlling interest and included in the non-controlling interest reported in subsequent consolidated financial statements.